This is Robert Kraft, and I'm your host on SNN.Network. And with me today for this Wall Street View is Tobias Carlisle, a frequent guest here on the podcast and also on Wall Street Views. And if you didn't catch his last keynote presentation from our conference, I highly recommend you do so. Tobias, welcome back to the program.
Thanks for having me, Bobby. It's great to be back.
It's great to have you on. I think at this point some people might be thinking we're working together, or you're working for us, or I'm working for you. So I appreciate you coming back on again.
Well, it's because you're giving me that big slug of options, right, in the business.
That's for sure. So for those who may have missed one of our first 1,000 interviews here, what's your background and how'd you get started in investing in finance?
I was a mergers and acquisitions lawyer for about 8 years, and then I transitioned into activist investing in about 2008. And so since 2008, I've been a deep value guy, and I've more recently I set up a firm in Los Angeles, which is a SEC registered firm, and the focus of which is an ETF called the Acquirers Fund, and the ticker for that is ZIG.
And, I think at some point someone is going to come back to us and say, I wrote a book called Deeper Value Investing, like a 7-minute abs, we're going to have 6-minute abs.
6-minute abs.
So the reason I had you on today is I wanted to discuss the recent article that you wrote for the MicroCap Review magazine. It was titled My 8 Rules for MicroCap Value Investors. And now before we get into those 8 reasons, for those who think value investing is strictly a small cap and above type strategy, the 1 billion in market cap or higher, why then do most microcap value investors cite books like Intelligent Investor, One Up on Wall Street, and Buffett annual letters as sacred texts for why they're microcap value investors?
There's a few reasons. One of them, I think, is that Buffett started out as a microcap investor. He was genuinely buying things that even in the day were very, very small, very, very illiquid, hard to buy, which, you can just use that as a factor and you can get pretty good performance from illiquid and small and micro. And the other reason is just more logically, if they're off the beaten path and it's hard for big institutional investors to invest in them, then they're underfollowed by analysts and you're much more likely to find wide mispricings in that group, which should lead to really good returns.
Mm-hmm. So then why, just go again, before we get to the article, I got to follow up on this, then why would you say that, because I'm in business school class, I'm in my final semester, and literally every class I hear people talking about, I invest in, this stock or that stock, and it's all billion or above. And, they're talking about value investing strategies, looking at ROIC, and not even one consideration for something that, let alone a billion or less, 500 million in market cap or less. Why is that? Is there this disconnect, or there's still just this information gap there available? I mean, should I be doing twice as many of these? I mean, what do you think, Toby?
Well, you can't rely on other well-known investors often because they just can't have a position in these stocks. You've got to do all of your own research, and immediately that turns some folks off. The other thing is that there's a point where the smaller companies have a little bit more financial risk. They just don't have the robustness of their bigger brethren, and you should get paid for that. For that increased risk, you should get a bigger return. Mm-hmm. And so you just have to be careful as you dig through to find ones that, if there's some sort of downturn, like Graham, for example, had a minimum market cap. And I think he said, I forget now whether it was 70 million or 200 million, or maybe it's 200 million in modern day money. And his argument was they don't have the financial wherewithal to withstand a big drawdown. So that's just it. You just have to be wary of those. You just have to be thinking about them, but anybody would do that sort of analysis anyway. Does this company have the financial robustness to survive a trough or recession, a depression, and so on?
Right. Okay, so now to the article. I want to dive right in there. Rule number 1 that you had on there is zig when the crowd zags. So why?
So I think this is like fundamental to value investing. It's not something that I understood when I first started out. I'd read Buffett's letters and I'd read security analysis, and then I'd find a company that I wanted to buy and do a valuation on it and kind of tweak the valuation to get the answer that I wanted. And then I realized after doing that for a while that what you're really looking for is a wild mispricing. Something is just incorrectly priced in the market. And so the way that you do that is the only time you're going to be able to buy something that nobody else wants is if it's an ugly business. There's something wrong with it. It's got some hair on it. And you find these things that people are just desperately trying to get out of. And so they sell it down well below what it's worth. That's when you want to buy it, because those are the stocks that if there's some recovery, if it's not as bad as it looks, if sometimes people just get bored with stocks and they haven't done anything for a long time, so they trade down. So I think that it's important to remember that what you're trying to do in order to beat the market, you have to have a portfolio that looks very different from the market. And that'll mean that sometimes you're going to have a lot of tracking error in your portfolio. Sometimes that means you're going to underperform by a lot. That's what's happened to value over the last 5 years. It has underperformed by a lot. But in other better times and over the long run, there's a thing called the value premium, which is the outperformance of value over the market in general. And the only way to earn the value premium is by buying stuff that other people don't want. So you have to zig when the market zags.
Well, let's quickly to follow up on that point is, I think about sectors like, actually I saw a tweet the other day that was, they were talking about how the oil market in Alberta or something like that has really seen a steep decline, so the tweet was like, oh, maybe I should start looking at this, but I know for traditional value investors, sometimes, commodities markets and basic materials is most often kind of overlooked because it doesn't tend to follow most value investing principles. So what would you say to that, when you see that there's certain sectors that are starting to kind of go like this and, according to this zig when the market zags, like, okay, well, if everyone else is going to these other parts, but there's this kind of, you see it starting to go into the trough for this other sector, how would you answer that question?
Well, there's two elements to it. One is Seth Klarman says that a good value investor is a contrarian with a calculator attached. And so that means that when the market goes down, you've got to go and do that. The market doesn't want it, but I have to go and figure out if I in fact do. And part of that is undertaking your own valuation, figuring out if it's something that you want to buy. The other element to that, though, is that cyclical stocks can be more difficult to value, and stocks that rely on a commodity can be more difficult to value. So many value investors just exclude them from the universe of things that they're prepared to look at. I don't. One of the things that makes me a deep value investor, I just look at the cycle. I look, what did this thing earn peak cycle? What did it earn trough cycle? What's it earning now? And if I can come up with a normalized earnings for it, and then I want to buy at a big discount to that normalized earnings. So then what I'm hoping that I see is that the business improves as the commodity or whatever gets a little bit higher, and the business does a little bit better. Often these things have an enormous amount of operating leverage, so they're losing money at one price, and then at a slightly higher price, they're wildly profitable, and they look like a completely different business. So I want to buy them before that happens, because that's when they're cheap, when they're losing money. When they become wildly profitable and they start looking good, and I'm a vendor.
Got it. Okay, so now rule number 2 that you have on this article is buy undervalued companies. So what's your advice here?
I mean, that's really the fundamental approach. You either have to be you're a growth momentum style investor looking to the very far future. So you're looking at something that probably hasn't been proven as a business but has some promise. And you have some view on the widget or whatever the business is that it can do something very well in the future. I think that is a much more difficult thing to do than to value something that has had historically, pretty good earnings. I can see what it's done in the past. I've got an idea what it can do again in the future, even though at this point in time it might be in a cyclical trough because oil's crashed. Oil companies look terrible when oil crashes. So undertake the valuation, buy them undervalued, and then you get the mean reversion in the business, you get the mean reversion in the stock price discount to the underlying intrinsic value. And with those two ways, I think that's a very robust, well-established way of doing very well in the market.
Got it. I have to follow up real quick because this is one question I've wanted to ask you for so long. I don't know why I just haven't asked you yet. What would you say is your favorite qualitative metric that you look at?
Yeah, so that's a really good question because every time I find a qualitative metric, I try to quantify it. And so, there's lots of things that I have struggled to quantify. One of them is insider buying. So insiders sell for all sorts of reasons. Sometimes they sell just because they want to diversify the risk. They've got a huge concentration in the business that they started or they were there when it was founded, and they're just trying to sell down to buy a house, want to buy a car, put their kid through college, whatever the case may be. People really only buy for one reason, and that's because they think it's really deeply undervalued. I've struggled to quantify it, but I think it's a very powerful signal when you see management who understand the business buying some, even when they've got a material holding. I think that's a very good signal.
Got it. Okay. Listen, I know we could do a whole podcast just on that question alone, but I will not digress. We will continue on with the 8 rules. So, and plus, I invite everybody to go check out the acquirer's multiple, because that is Toby's attempt at quantifying the qualitative, if I may. Right.
That's all quant signals. But I've never been able to include the insider buying in there, and it's something that hopefully I'll figure it out one day.
One day, don't worry, we got plenty of time. So rule number 3 is seek a margin of safety. For those who think microcaps are just a bunch of landmines, how do you do this?
So that's really fundamental to value investment, and the reason that you seek a big margin of safety, and what that means is that you come up with an estimate of value, and then you're trying to buy at the deepest discount to that estimate of value as you possibly can. And it's one of those places where risk and reward don't go together. The more that something is discounted from its value, the higher the reward and the lower the risk. And the reason for that is that you might make an error in your estimate. If you think it's worth $100 and you're buying at 50, and it turns out it's only worth 75, then you're still in something that it's still got a 33% upside to your estimate of intrinsic value, even though you made a mistake. And so I assume that a lot of the things that we just make mistakes in calculation. Businesses are, even reasonably stable, solid businesses are difficult to value, and folks will have different views on the valuation. So I just try to come up with an estimate and then try to buy it as a bigger discount to that as possible. It's particularly apt in microcap world where they're very fast moving, they're difficult to value. So the bigger the discount, the better.
Yeah, because we're dealing with a lot of people where you're talking about prices going from 10 cents to 20 cents, and you're having these wild moves, and you really hit on a good point there, is that it moves so quickly sometimes that it's tough to really, you value it at this point, but maybe you've missed the timing because you had it priced at 5 cents or even at 12 cents and it already ran up to 20, and
if they're growing at a very high rate too, so your estimate might be 10 cents this year and you can buy it at 8. It runs to 15, then you do a valuation, you think it's worth 13. Do you want to sell that or do you want to hold that because you think that you've got some more growth in it? That's a difficult question. I don't know how to answer those questions, but that is a difficult question to deal with.
Oh yeah. So actually we get to that in one of your rules a little later, so we'll dive in that. So rule 4 is you say treat a share as an ownership interest, not a mere ticker symbol. This is, in business school, it's kind of like investing 101. It's when you're investing in a share in a company or you buy a share in a company, it's like investing in the business. But for some people, especially in the microcap game, patience can most definitely be a virtue, or you would hope it's a virtue in your investing style. What were you thinking here? How do you navigate that push and pull between wanting to be that long-term investor versus it being a short trader or trader?
It's fundamental to investment, and that's an idea that I stole directly from Graham or Buffett in one of their writings. And I think it changes the way you think about the business. It changes the way you think about the stock. If you think about it as a ticker symbol, then the only way that you can judge your performance is by the wiggles in the ticker symbol, which on a day-to-day basis, either you're going to be happy or unhappy. If you think about it as a business, you recognize that it doesn't change that frequently. Really, you're updated on a quarterly basis, but you might need 2 or 3 years of returns to kind of get an idea about the underlying trajectory of the business. So if you think about it in those terms, it slows everything down and you start thinking about your own valuation rather than what the market thinks it's worth. And particularly, this is important. If you're a value guy, you already think that it's mispriced. You're buying it at a big discount to what you think it's worth. So if in the interim, it gets more mispriced because the market goes in the wrong direction, you can't get upset with the market because you're already taking advantage of that, even though it sucks if you buy something and it goes against you. But if you go back to your own valuation, think about, I'm only going to update this in a quarter. I'll see what's happened, and then take in the ordinary seasonality, cyclicality of the business. I think it's just a way of slowing down the analysis, which I think in an HFT rapidly speeding up world that can be an advantage. And I think that it's called time arbitrage. You just think about it in a slower way, and it should help you outperform.
So then, rule number 5. Why do you warn investors to be wary? This actually goes to the point that we were talking about earlier. So again, rule number 5: why do you warn investors to be wary of high earnings growth and profits?
Well, statistically, high earnings growth and high profitability. And when I'm saying profitability, I mean scale to invested capital, return on invested capital. Historically, growth and high profitability are highly mean reverting, which means that something that is growing very quickly tends to slow down or reverse course, and something that's very profitable tends to become less profitable. And the reverse is also true. Something that is having a down cycle is more likely to upcycle, and that, in terms of growth and in terms of profitability. So I think that it's asking you to keep the mean reversion in mind. So build that into your model, that the growth and the profitability will be different in the future. You shouldn't build a model that compounds off into the sunset with an enormous terminal value, unless it's a very special kind of company that has that sustainable moat, sustainable competitive advantage, and there are very few of those around.
I would say especially in microcap land, that's for sure. Maybe in small cap land, but in microcap land, it's definitely, that's why we're in this space, is we want to find those, but at the same time, if you're disciplined and you've been around the game for a long time, it's very few and far between that you see some of those companies that have those rapid growth and are able to sustain that for the longer term, or they just get bought out like that, especially in this environment.
They could easily still have growth that is higher than GDP for an extended period of time. It's just that it's probably unlikely that the enormous explosive growth at the start persists for an extended period of time.
Don't worry, we're going to do an episode one day with examples of this in play, but I digress again. So rule number 6 that you put in there is use simple, concrete rules to avoid making errors. Kind of like these 8 rules, I would think. Or do you mean kind of a combination of quantitative metrics and qualitative observations?
No, I mean literally have your process. I think you should document your process, and I think you should, with a checklist, and you should go through your checklist for every single position that you put in. And the reason for that is that there might be, when you get excited about a stock, and I'm as guilty of this as anybody else, I want to immediately rush out and buy it. And I know that if I just do 2 weeks of work on it, then I'll be in a vastly different position to where I was when I first found it. And that that first cut of all of the metrics, you find that it's extremely cheap or whatever, and it's probably unusually priced. But then if you do the 2 weeks of diligence, you'll find there's something wrong with the covenants and the debt, or it's got some off-balance sheet liability that should properly be pulled in, and that does change the complexion of the trade. So it's just an idea that to control your own behavioral errors and limit control your cognitive biases and limit your behavioral errors, you should have a strict process. And I say concrete rules because you need to be able to make a decision, yes or no, for each of these rules. And if you can't answer the question through this rule, you try to exclude the rule or change the nature of the question.
It's interesting. I just published an interview with on the podcast with Bill Naskovitz, and he was talking about how he used to have 12 rules, as part of his investment process and thesis. And over the years, he's now culled that down to 10. But at the same time, he said he's done, at this point in time, even more research than he has done maybe in previous years. So I thought that was a pretty interesting point. It kind of ties into what you're saying here is that, while you have your concrete rules, over time, especially with how markets evolve and the changing environments, they can change. So while it's concrete, there's also, would you say there's some room to wiggle?
I just think it allows you to spend more time thinking about what you're doing rather than, you go through, check all of the boxes so you haven't forgotten anything.
Mm-hmm.
And then you know that you've been faithful to the process, and then it frees you up to spend time thinking about the position rather than concentrating on trying to check all these little things off.
Right. So rule number 7 is concentrate, but not too much. So what did you mean here?
It's a delicate balancing act, and the answer is going to be different for each investor. Some people I speak to think that 40 positions in a portfolio is a concentrated portfolio, and other people say if you have more than 10, you're building an index. Mm-hmm. I disagree with both of those. Somewhere in the middle is the case. You just need to have enough of a position. If you're going to do some work on it, you need to have enough of a position so it's meaningful to your portfolio if it works out the way that you want it to, but enough diversification so that if you're just dead wrong, then it doesn't hurt you so much that you can't recover. And I think portfolio management is half of the battle. I think selecting the stocks is half of the battle, and the other half is sizing them appropriately. Mm-hmm. And I think that's an enormous under-researched source of alpha for guys like Buffett and other well-known investors who, when they have the big winner, they seem to have enough of it that it makes a big difference. Mm-hmm. When they have a loser, that doesn't really affect them that much.
Mm-hmm. Okay, so and finally, rule number 8, you want to aim to maximize, according to your rules, the goal here is to aim to maximize after-tax gains over the long term. What are the implications here?
Well, in any position that you put on, there are a number of ways that you might express that view. You could just be long the equity. You might be long a call option. You could sell a put option, and those are all long positions in the stock. And you could short a position. You could sell the call or buy the put, and those are all ways of expressing the short positions. None of them. They all have different attributes, and they all have different risk and reward profiles. But they also have different tax implications. And if you buy something, just a simple position in equity, and it reaches your estimate of intrinsic value inside 12 months, and you're in a taxable account, you're paying short-term capital gains on that. Mm-hmm. And you can work out what your rate of return needs to be in a short-term capital gain world versus a long-term capital gain world. So short-term capital gains, you need to be doing something like 40% a year to generate the same returns as a 15% long-term capital gain record versus someone like Buffett who just doesn't sell, so he doesn't incur those capital gains at all. It's just important to think through the after-tax implications of what you're doing, because I think that it's something that it varies from investor to investor, and people don't speak about it a lot because there's the experiences are going to be different from person to person. So it's something that I always do, and I'm always looking for tax efficiency in the way that I express my investments, and I'm looking for tax efficiency in the portfolios that I manage.
Mm-hmm. So, Toby, we're going to do another video just on that point because I haven't talked about that at all. So that is next interview. It's happening. So, Toby, for those who have read the article in the magazine or are watching this interview right now, what should be their main takeaway from reading this and watching this?
Well, I think you should have your own process. You should have your own list of rules. I think I have a pretty good list of rules that I've just stolen from Buffett and from Graham and from Seth Klarman. And I've stolen blindly from everybody I can possibly think of who might have a good idea. Mm-hmm. And then I test my rules. So I'm quantitative. I like to take the ideas and see what they would have done historically. So that's my process, is to find something that makes sense to me as a value investor, test what that would have done in the universe of US stocks going back to about 1963, look at different rebalancing dates, different concentrations, different rules. So that's my process. You don't need to necessarily test them like that, but I do think there's a lot of research that shows that it's much better for you as an investor to have a defined process that is concrete and written down that you follow with a checklist on a regular basis.
Got it. And for full disclosure, I don't think you mentioned any companies in this interview, but just in case, do you own any shares or in any companies that were mentioned at any point said during this interview?
The only thing I own shares in is the Acquirers Fund, and the ticker in that is ZIG.
That was a good plug. So with that, Toby, where can my audience go and find more information about you, the Acquirers Fund, the Acquirers Multiple, and also your podcast?
So my website, acquirersmultiple.com, that has a /podcast for the podcast, /blog for the blog, and that's got all of my books on it. So I've got Quantitative Value, which came out in 2012, Deep Value in 2014, Concentrated Investing 2016, and the simplest of them all is the Acquirers Multiple, which came out in 2017. And the firm that I manage is called Acquirers Funds, and we have an ETF, which we've only just listed, and it's a nanotech. It's a nanotech. It's a nanocap. It's definitely not nanotech. It's a nanocap, but it invests in a slightly larger universe. It's very, very small, and we've got high hopes.
Awesome. Well, Toby, thank you again for joining me today, and I look forward to the next interview, which I think, knowing us, it's going to be tomorrow.
Thanks for having me, Bobby. It was really fun.
All right, thank you.